Good morning, guys. I am in my place in Missouri. As you can tell, the background, today I'm hunting, so it's really early. It's according to my computer, it says 4:44 a.m. So getting ready to get out. Tree stand hunting, it's not my absolute favorite, but you get to see a lot of activity out here where I'm at. A lot of different deer running through here. Saw some stuff happening yesterday, a little bit far away from me, be able to take any sort of shot, but just kind of took in the surroundings, got in late yesterday, and then going to get in a couple of days here and see what happens. So we'll just see how things all work out. Hadn't had a chance to really look at how the market's going to, I don't know how the market's going to open because, right now it's people are still sleeping. They haven't made, most of the world is. East Coast, they're working their way over there to Wall Street, going to start opening things up soon. I'm going to go on the extraordinary assumption we're going to be somewhere where we're at now. So I'm guessing that just because these last few days we stayed in this range, and I'll be able to show you what's going on in those range. But before that, I did have a question come in from our Irina Kalinik, and let's just take a look here, see what she had to say. She asked, would I refinance now loans that have a 3.5% interest rate to get more equity out to buy more properties? So that is going to be a math problem. That's going to be something where you have to look at what your cost going to be, right? Because you still have to go into the cost of the loan to get the new loan. You have to look at the cost of your new payment on that property, but then how much capital you're getting out, where are you going to be able to deploy that, and what is the returns there? Now, we also know on these returns, we're talking about that. Everybody's really wrapped up in cash flow. But if you're buying properties with that money, you can keep it reasonably rented for the entire time you own it, and you can raise rents on, you may see a decline in total cash flow coming in. Even though you got three different forms of cash flow happening from the first property, you're going to see a decline in cash flow because you've now taken more out. You've now increased the rate that you're paying it back at because we're no longer at that 3.5%. But now you've redeployed it into two other places. What are those cash flows? Are those cash flows going to be similar? Are they going to be lower? What are they? Then you got to start mapping out your rent raises on all these properties, right? It may take you 3-4 years to pass where you were and then to compound growth from there. The other thing that we have to consider is you've got 3 properties not being paid down by a tenant. Well, we've run those numbers before. If you're getting a $100,000 property, putting 20% down, let's say you got $6,000 in costs associated with that to close. So you're $26,000 in on this transaction. You got $80,000 in loans. The tenant's going to pay over time $2,666.67 per year towards that balance. That's the average over 30 years. That means your initial deposit of $26,000 is going to grow by 10.25% every year just by them paying down the note. That's the first place you can look at where your gains are going to be. Then you're going to be able to raise rents. Is it 5%? Is it 8%? Whatever that might be. Look at that compound cash flow, because every year you're going to be able to raise that, or maybe every 2 years. It's kind of hard to say. Map that out a little bit on the conservative side. Then you've got appreciation and tax benefits. You may see a drop in cash flow on the first one, but if you're able to park it into a couple more properties, the cash you pull out, because the cost of that cash, you're going to see the increase in your monthly payment. You're also going to see, of course, the money you spent to get that cash out. But that's a one-time spend. Pull that money and put it back out there. It's not costing you really much of anything to redeploy that capital. It's a one-time expense. But you now have literally picked up 2 other properties with somebody else's money that somebody else is paying back. And sure, you're not making as much cash flow on the one, but you got the cash flow on the 3, plus the compounding pay down on those, the amortization of those loans, plus compound appreciation, plus the compounding tax benefits you're going to get from it. When you start to look at all of that, the returns are pretty, I would say, close to infinite, because it's not your money. Your initial money invested was the down payments into the property, the first one you bought, if that money came from your account. Now that you're pulling it out and borrowing from other people, as long as you're purchasing a properties that will stay reasonably rented for the entire time you own it, you can raise rents on. Now your returns are really hard to map out because it's not your money. Your money's still in there at that 20 or 25% down, plus the cost from the very first one. Everything else is somebody else's money and somebody else paying back. So it's difficult to quantify it, but you need to wrap your head around it the best that you can to feel confident with what those numbers are, and that if you feel like you're going to get back as much or higher to where you would have been had you just stayed in the one. So it's going to be a big math problem, but it's a math problem worth doing, and if it's something worth solving. So put some time into that one. I can't answer it directly. I wished I could with actual numbers here, because I don't have the numbers on the properties you're going to have. I don't have the numbers on the exact property that you're thinking about right now. But look at that for yourself each time you consider that. The interest rate really doesn't matter, guys. A lot of times people are trying to tell you it does. The reason they're trying to tell you it does is because they're trying to soften somewhere else over here instead of trying to really focus on the entire deal as a whole. There's a lot of phenomenal deals out there. A lot of people walking away from good stuff because they're not getting their cash on cash return. To me, it's the shittiest metric. Anybody who's just focusing on that, they're not paying attention to all the things, and they're really not helping you as much as you wish that they would, because there's a lot more math to do. It's just harder. So, got questions for me? Bring them up. We'll talk about them. We'll get more into the math if you have deals to actually run numbers on. Let's take a look at what our charts are doing today. Okay, so here's what we got. I am showing you where we have, decidedly stayed in a new channel, which is good. I'm glad that we're in this new channel. So here's what our resistance was previously. This is where we're bouncing up against before, and we had this big wide trading range. What I've also put in here is the moving averages that that are helping us. And in that respect, where they're helping us right here, we've got the 50-day moving average, where it's going to be another floor for us. And then we've got the 100-day moving average is going to be a ceiling for us. So we're going to be bouncing in between there. But we also have this ceiling, which right now has been resistance quite a bit, but it seems to keep fighting above it, but we're dropping below it too. So this is going to be a little bit of another battle line, but here we are. I think we're going to be going sideways for a little bit just because we have these averages. It's going to act to that ceiling and that floor, keep us in a little better position than where we have been. So I'm encouraged with where we're at with the interest rates. I think we're in a very good spot compared to where we have been to be able to get those 30-year fixes and not allow those arms to tempt you into a place that it could get ugly. It could get really, really ugly for you. Let's put it this way, I've seen it be very ugly for people, and it's a lot safer to go into the 30-year fixed, set your business, focus elsewhere, instead of having to worry in the back of your mind, what happens when this starts adjusting? Where's this going to put me? What's it going to do to me? Need anything, guys, shoot me a question, shoot me a text, shoot me a call. I'm not going to be so available today, right? But I'm going to have some availability here and there. I'll do my dangest to jump in and help out. The team's always on. Got everybody there, 30-some people there ready to work for you. Whatever you need, they're here to back you up and get you to where you need to go. Thanks, guys. We'll talk to you on Tuesday.